Hi everybody, good evening. Welcome to tonight's webinar. My name is Ivy and I'll be your host tonight. So before we start off, here's a little disclaimer for whatever we share tonight is just for general information and educational purposes. So it does not constitute to any recommendation to buy or sell any investment products. And here's a little background about our company. So our company is called Phillip Capital Sendirian Berhad. We are incorporated in the year 1995, and we are a wholly owned subsidiary of Phillip Capital Holdings Sendirian Berhad. And some of you may know we were formerly known as Phillip Futures, but as we grew and expanded our service and offerings, we have since renamed ourselves as Phillip Capital. And apart from that, we are also trading participants of Bursa Malaysia Derivatives, participating organization of Bursa Malaysia Securities Berhad, and also a holder of Capital Market Service license. So Phillip Capital have offices across Malaysia. Our mother company is actually from Singapore, but our HQ is based in KL, Kuala Lumpur, and we have a total of 11 branches across both East and West Malaysia. So if you're from any of these cities, you're welcome to drop by our branch and inquire about our investment related services. And this slide shows the Bursa Excellence Awards that we have received for the past few years. And last year, we were also very honored to be awarded as the first runner-up for the Best Retail Derivatives Trading Participant, as well as the second runner-up for the Best Overall Derivatives Trading Participants. So Phillip Capital has a wide global network. We have offices in 15 different countries as located here in the map. As such, we do serve an international client base. Yeah, and for futures trading, we also provide products listed in global exchanges from the US, like the popular exchanges CME, CBOT, COMEX, and NYMEX. We also have exchanges from Europe, Japan, Hong Kong, Singapore, and also Malaysia. So with our global coverage, client can trade both local and foreign products within the same platform. Okay, we are your one-stop solution for your trading. And now we move on to our products. We offer three main categories. The first one is futures, which include diverse markets like the index future, agricultural metal, energy, and interest rate futures. And the next one is equities or stocks. You can trade Malaysian shares, US shares, Hong Kong shares, Singapore, and Australian shares with us. And for the third one is contract for difference, or also known as CFD. We offer local Bursa shares and also US CFDs. And if you want to trade the US indexes itself, like the Dow Jones, S&P 500, and also the Nasdaq, we offer the CFD at a very attractive rate. So why are we the broker of your choice? Firstly, Phillip Capital is an award-winning broker, and we are well established and also recognized in the market. Secondly, we offer 24 hours broking and executional support. If you have any issues regarding your trades or accounts, you can call in our dealing desk, and we have dealers ready to assist you. The third one is that we provide advisory service on what products you would like to trade or how you can get started, and we also send latest market news to our clients on a daily basis. So you can be sure to get the latest updates. And as mentioned earlier, our clients can trade a wide array of products through our platform. And lastly, we have online account opening, which is very convenient for you to start. So apart from all those, we also provide free one-to-one coaching session. So if you like a more personalized coaching on futures trading, for example, or how to use the platform, we can always arrange appointments to guide you for free. And we also frequently conduct free seminars and webinars, and you can also start trading by opening the account for free. So for the trading session, it's actually more tailored for beginners who want some guidance on this topic, like how to start trading and about the product knowledge, platform, and charting system. So yeah, so if you're interested, we're more than happy to assist you. And at Phillip Capital here, we are constantly providing educational resources for investors. You can check out our upcoming seminars and webinars by scanning this QR code, or you can visit our website at phillip.com.my to check out the schedule. We invite speakers from the industry to give market updates and insights, so it's a good learning opportunity, I would say. So do join us for our events. And we also conduct these weekly market calls, so you can join our research team on the market views and updates for newly published reports every Monday at 11 a.m. Or if you want to learn, a more like technical analysis, like how to spot or entry or exits, right, then this is for you. Our analysts will do a technical analysis on live counters every Monday night at 8 p.m. We have online account opening, so you can open your account for either future stocks or CFD with us with ease and convenience because you can just do it online in the comfort of your own home. So if you do want to open an account, you can just maybe take a screenshot or scan the QR code right here, and it will directly take you to the online application. So I will wait for 3 seconds before I proceed. Okay, so now onto our trading platform. The platform that we use for futures trading is called Philip Nova. It's actually very simple to use. So we have mobile apps for iOS and Android devices for those who like to trade on the go. Our platform is equipped with a wide range of technical indicators like live charts, market depths, functions, and you can get access to both local and foreign products. So if you're not our clients yet and you want to try out our platform to see the interface, we also have a demo account for you to try out, and you can scan the QR code there, and I will wait 3 seconds as well before I proceed. So our live charts are powered by TradingView, where, like I mentioned before, you can trade local and foreign products in one account, and we offered 17 global exchanges like XGX, Hong Kong Exchange, Japan Exchange, and we also offer 24 hours broking executional support, and you can also sign up for a demo account to try out. So this is for stock trading. The platform that we use is called Plums Global 2.0. Our platform offers all-in-one stock watch list, charting indicators, exchange, top 30 movers, powerful stock analytics, and market steps. So this is a platform which is very suitable for new and experienced investors. So for the next platform we use for CFD is called Philip CFD Trader. Our interface is very user friendly, and it also has live chart price alert, live market price mirroring, exchange, and advanced order type. Alright, so moving on to promotions. We are currently running a promotion called Trade CME Micro Futures, where if you open an account with us and trade CME Micro Futures, you can win up to 1,588 cash rewards. So this promotion will run until the end of July, so it's a very good time to start. And you can scan the QR code there for more information. So I'll wait for 3 seconds before I proceed to the next promotion. And for our second campaign is called Trade Singapore Shares, and whereby you can trade Singapore shares and win up to 200 ringgit Aeon vouchers. And this campaign has actually been extended till May, so there are still a few days left. And again, you can scan the QR code there for more information. And our last campaign is called Trade US Index CFD at $2, where you can enjoy the best rate for trading US indexes CFD with us at only $2 per contract. And you can also scan there for more info. Alright, so before we dive into our topic tonight, let me introduce to you our speaker, Lawrence Lee. And he is currently a Chief Investment Officer at Continuum Alpha Wealth Management, an independent asset management firm where he develops and oversees the overall investment platform representing the firm's investment views, strategies, and all related investment products and solutions to RMs and ultra high net worth clients. So prior to Continuum Alpha, Lawrence was a CIO at another EAM for 5 years, managing USD 4 billion of AUM. Lawrence has 15 years of experience across major asset classes with fund management experience in both the private wealth and institutional space. He has also worked with UOB Global Market Division, where he co-managed 8 billion USD global fixed income portfolio. He also has an honors degree in economics from the National University of Singapore. In addition, he's a CFA charter holder and a certified financial risk manager. So we are very honored to have him on board with us tonight. So do seize the opportunity to ask him any questions by dropping your question in the comments box later, and we will address them at the Q&A session. And we also have a special session later after the Q&A, whereby if you could answer Mr. Lawrence's question, you will be entitled to win a touch and go reload pin worth 20 ringgit. So without further ado, let's welcome Mr. Lawrence. Mr. Lawrence, I'll pass the screen to you now.
Thank you, Ivy.
Okay.
Good evening, everybody. The topic tonight is CME Yield Futures, Insight Strategies and Trading Dynamics. So before we begin, I'd like to also highlight that the information in this webinar is general and not meant to be investment advice nor product recommendation, and neither does this constitute an offer or solicitation of our products and services to you. So the outline agenda for tonight is as such. First, I will introduce what is interest rate and what is the US Treasury market. Then after that, we will talk about very important fundamental bond concept, which will form the foundation of the topic for discussion tonight. Then we will talk about Treasury and micro Treasury futures, because it's very important to understand the evolution of the Treasury futures market to see how we actually got to the CMEU futures. The bulk of the time tonight will be spent on yield futures, and then I'll talk a little bit about the current interest rate and the Fed outlook before going through 4 case studies to let everyone understand the application of yield futures. Then we have a question and answer session where I hope to answer any questions you might have. So what is interest rate and who sets them? So interest rate is something I think that everybody would actually want to know more about, but either it is not as well known as equity or forex, because it's just not a very readily traded financial instrument by the general public. So to put it simply, interest rate is actually the price or the cost of borrowing money, and it actually affects almost everybody via various transmission mechanism. At an individual level, interest rate affects how much you get out from your fixed deposit. It affects your saving rates. It affects how much you actually pay for your housing and car loan. At a corporation level, it affects business decision whether they want to invest in expansion. Then for government also needs to borrow money by issuing debt or bond, to finance social security, defense, education, etc. And they also have to, it affects the cost of the interest payment on them. For financial asset, which is always the present value of future expected cash flow, the higher the interest rate, it affects the valuation of this financial asset. And for currency, typically a higher yielding currency would get stronger, and that will also affect how much you pay for import and affects your export. So you can see the interest rate is something that affects economy. It affects everybody, and that's why it's important. So who actually sets interest rate and what is known as the monetary policy? The US Federal Reserve, otherwise known as the US Fed, is the most important central bank in the world because of two main reasons. Number one, the US dollar is the reserve currency of the world. And number two, the US is the biggest economy in the world. That's why there's often a saying that goes, when the US Fed sneezes, the rest of the world catches a cold. The Federal Open Market Committee, otherwise known as the FOMC, is a branch of the US Fed, and they are the one that determines the direction of monetary policy. It holds 8 regularly scheduled meetings, although if the situation calls for it, like COVID, they can actually have a meeting outside of these 8 scheduled meetings. The last meeting was on the 1st of May, and the next one would be the 12th of June. So they follow a regular schedule. And financial market often will attempt to predict whether the Fed will tighten or ease. So in the financial jargon, tightening means they become more hawkish, and when they ease monetary policy, they become more dovish. And when we say they are being more hawkish, it usually results in an increase in interest rate and vice versa. It's important to note that the Fed has a dual mandate, which is to maintain maximum employment and price stability. So with that backdrop, I'm going to move forward to what is the US Treasury market. It is the largest and most liquid interest rate market in the world. If we look at today, the total outstanding amount of US Treasury debt is about 34 trillion US dollar. That is a very, very staggering amount. So the US Department of Treasury, which is also known as the Ministry of Finance in most countries, they will issue this bond at auction, and these are known as primary market. And after that, they can be bought and sold in the secondary market. It's also important to note that US Treasuries are deemed as a safe haven or a flight to quality instrument. So in times of crisis, in time of war, or risk-off event in the financial market, people generally will flock to buy treasuries because it's seen as a safe haven instrument. So as mentioned earlier, US public debt hit a record 34 trillion. And if we look at the CBO forecast, it is expected to keep going higher and higher relative to GDP, and it's estimated by experts to be an unsustainable path. And for the US Treasury auction, the table shows the schedule. And when we say on the run, it means the most recently issued US Treasury bond or note. And when the next auction happen, the previously on the run securities will become off the run. And generally, US Treasuries are divided into three categories: bills, which will be securities below 1 year; notes are up to 10 years; and bonds are generally those securities longer than 20 years. It is also important to know that there's something in interest rate known as the term structure, or we call it the yield curve. So different maturity, we can't expect them to have the same interest rate. So like a short end, like a 2-year bond and a 30-year bond, generally the yield levels will be different because market participants will have their own expectation of how interest rate and monetary policy change. So it result in a change in the shape of the yield curve. So the yield curve can either be upward sloping, downward sloping, or flat. And in the case of today, the yield curve is actually downward sloping because the front end maturity, as you can see from the chart here, are higher. It's about 5.4, 5.5%. And the long end at the 30-year is about 4%. So when the front end is higher than the long end, the curve is downward sloping, and vice versa. So what are some important bond concept everybody should know? I think a lot of you probably have heard of this, that bond prices and yield, they have an inverse relationship, i.e. when interest rate go higher, bond price fall. And when interest rate goes lower, bond price rises. So we all know there's an inverse relationship, but how does it come about? It's actually a very simple mathematical relationship, because the price of a bond is actually the present value of all the future cash flow. So if you look at a bond, you always have your periodic coupon and all the way to the last coupon and the principal. So these are all your cash flow that you expect. And when you calculate the price of a bond today, you have to know what is the present value of all this cash flow. So the interest rate is in the denominator. So when the interest rate is higher, the whole cash flow actually becomes smaller, and it results in a lower price of the bond. So this is the mathematical equation behind this inverse relationship. So when interest rate go higher, present value of the future cash flow gets smaller and the price of the bond is lower. The second important concept we need to understand is duration. So duration in the context of a bond, it actually is a sensitivity measure. It measures how much a bond price will change if interest rate changes. It is not exactly the same as a bond's term to maturity. It is only the same when we talk about zero coupon bond. But otherwise, a duration is affected by a bond's maturity, yield, and coupon. So generally, if you look at a 2-year bond, the duration will not be 2. It will be slightly lower, like 1.85. 10-year is about 7.95, 30-year about 16.5. This duration can change, but generally it reflects the a longer maturity of a bond. You will typically have a longer duration, and it means that it is more sensitive to interest rate changes. So if you look at this table, for every 1% change in interest rate, the bond price will change by it will move negatively by 1.85% for the 2-year, and 7.95% for the 10-year. So the inverse relationship holds here. The third important concept is DVO1. So duration is a broad concept, it's a sensitivity, but how sensitive is it? So DVO1 actually measures the sensitivity in terms of dollar. It means the dollar value per 1 basis point. So what is basis point? Basis point simply means 100 of 1 percentage point. So 1%, you have 100 basis point. So how do we calculate DVO1? There are two simple ways to calculate. One is the more proper way or more theoretical way. So we take an example of a 10-year US Treasury note. The last price is 95-17. You notice it's quite interesting that it's quoted this way, -17, because it is important to know that treasuries are quoted in 30 seconds. So this price would be 95-17 divided by 32. So it is the only bond market in the world that is quoted this way in 30 seconds. So you simply take 17 divided by 32. The actual price of this bond is 95.53125. The modified duration is 7.95. The yield is 4.57. And the cash price for 100,000 face value is simply 95.53125 multiplied by 100,000. So the first way to calculate DVO1 is you literally take the change in price for 1 basis point movement down and 1 basis point movement up. You sum the two up and you divide by 2. So when the interest rate move 1 basis point lower, the absolute price change is 76.39, and correspondingly is a negative 76.32 for 1 basis point move higher. So we take the two, we sum up, we divide by 2, that is the DVO1. But it's very cumbersome to calculate DVO1 this way. So there is a second way which market practitioners generally use, is approximation by modified duration. So it is very effective measure for small changes in interest rate. So simply we take a modified duration, multiply by the price, and we times 0.0001. And you will see that the DVO1 in this case is 75.95, very, very close to the earlier example. But the more important concept here to know is the longer the maturity, the greater the duration risk, and as a result, the price sensitivity, we have a larger DVO1. So with this, the next topic we're going to move on is to the US Treasury futures. So the US Treasury futures are first launched in 1977, and these are used by institution traders, hedge fund, mutual fund, bond funds. Almost everybody in the institution space will have to use these US Treasury Classic futures either for hedging or for speculation purposes. Even myself, when I started my career, this was the Treasury futures that we traded. So you can see that this is very complex. You don't have to worry about the details because this is not the main focus of tonight's webinar. But it's important to know this to actually know the benefits of yield futures. So you can see there are 8 maturity over here, and every single one they have a different face amount. And you can see that for every single maturity, they have a range of deliverable maturities, which I'll come to later. And you look at the minimum tick value, it also ranges from 7.8125 to 15.625 all the way to 31.25. So you can see there's a lot of variance. But one thing about this is they are very liquid. They are traded by almost everybody since 1970s all the way to today. It's a very, very liquid market and it's traded in price terms. That means they are quoted in over 30 seconds. For the classic treasury futures, it is physically settled. So physically settled means that the seller will choose when to deliver and what security to deliver. And to choose what security to deliver, they will usually choose the cheapest to deliver. And this cheapest to deliver bond will be the one with the highest implied repo rate. So notice earlier I mentioned that within every futures, there's a deliverable maturity range. So the seller has the right to choose between this maturity, the cheapest to deliver bond. So typically that is the bond with the highest implied repo rate. And the actual delivery process, which we are not going into detail today, is a 3-day event. But generally, people who trade futures, they do not want to take physical delivery nor deliver the underlying bond. They would typically roll the futures. So this is an example of the cheapest to deliver bond. So if you go to this particular Treasury futures, TYM4 means the 10-year classic Treasury futures, June 2024 maturity. If you have a Bloomberg, you hit a DLV command, this screen will come up. So essentially, Bloomberg has already sorted for you what is the cheapest to deliver bond. And in this case, you can see it will be the security that is highlighted in red, because that is the one with the highest implied repo rate. But again, don't worry about this. This is just to show that for the classic Treasury futures, they do physical settlement, and this is how they actually pick the bond to deliver. For the Treasury futures contract, to calculate the DVO1, there is a concept known as conversion factor. So earlier in this example, when we talk about DVO1 of, this is a cash bond. So this is how we calculate the DVO1. But when we talk about the Treasury futures, to get the futures DVO1, we need to divide the cash bond DVO1 by a conversion factor. So earlier in this table, you can see that there's a conversion factor for this particular bond is 0.9069, and that's why you will use the underlying cash bond DVO1 to divide by the conversion factor. So think of conversion factor as something to equalize all the eligible bonds in the basket. So because they are of different coupon, they are different maturity, etc., you need to equalize them, and the conversion factor does that equalization for you. So this is a very simple case study of the Treasury Classic Futures. So if you are the trader and you think that the US economy will keep strengthening and the inflation will, be higher than what the Fed expect, you believe that the US 10-year Treasury yields will rise. So to express your view, what do you need to do? Remember the inverse relationship. If you think that Treasury yields is going to go higher, you expect the bond price to fall. So in this case, you will sell the futures because you expect the price of the bond futures to decrease. So you proceed to sell 10 contract of the June 2024 10-year T-note futures at 108-08. So the trader views proved to be correct, and the price of the TYM4 declined. The yields actually rose. So the trader bought back the note, the futures at a price of 107-10. So if you notice here, I highlighted the big figure. It dropped from 108 to 107. So how many ticks is that? So 8 to 0 is 8 ticks. And then this is 30, remember it's in 30 seconds. So 32 to 10 is another 22 tick. So 22 plus 8 is a total of 30 ticks. And the dollar value for a minimum tick is at 15.625. So this is back to this table. 10-year T-note is at 15.625. And then because it's 15.625, every half tick. So over here, the difference is 30 ticks. You multiply by 2 is a total of 60 ticks. So to calculate your profit on this trade is the number of contract times the number of ticks and the dollar value for the minimum tick. So it's 10 times 60 times 15.625. The profit on this trade is 9,375. So notice that the classic Treasury futures, there are a few important points. One, they trade in price term. Price terms are quoted in 30 seconds. And then the minimum tick value changes from contract to contract. So it's a little bit, can be a little bit confusing for people who are not familiar with it. So because the classic treasury futures are used mainly by institution, it can be a little bit, the size can be a bit too big for the average trader, average investor who just want to, have a view on interest rate. So CME actually launched a micro treasury futures in 2024 that actually replicates everything of the classic treasury futures except for three key differences. Number one, they are cash settled. That means you don't have to worry about the physical delivery of the cheapest to deliver bond, etc., because everything is cash settled. And number two, they only launch it in two maturity, which is the 10-year and the 30-year, unlike the 8 maturities of the classic futures. And number three, the more important point is it is 1/10 the size of the classic treasury futures. So you look at the tick size from 15.625, it becomes 1.5625. So same for the DVO1, it is also lower. Even the initial margin is also expected to be about 1/10 the size. So these are the three differences of the micro treasury futures. But importantly, the similarities still remain that they are still traded in price term and they are still traded over 30 seconds. So now we move on to tonight's topic. So now you can understand it's very important to know what are the classic treasury futures, what is the micro treasury futures, and why CME actually launched a yield futures that is actually a more friendly tool, more intuitive tool for the average investor. So there are 5 distinct features of CME yield futures. Number one, they trade in yield terms and not price. So for the classic treasury futures and for the micro futures, they all trade in price terms. So if you think interest rate is going higher, you need to sell the futures. But for CME yield futures, because it trade in yield terms, it is more straightforward. It's very intuitive. If you believe that interest rate is going to go higher, you buy the yield futures. So there is no inverse relationship here. And number two, it is cash settled. So there's no operation risk of either delivering the physical underlying bond. You don't have to worry about cheapest to deliver, etc. So there's no operational risk. Everything is cash settled. And number three, it is also very small size. So it is also similar to the micro treasury futures. It is created for more average investor, more retail participation. Every price increment is only 1/10 of a basis point, and every 1 basis point is only $10. So you are talking about a minimum price fluctuation of just $1 per contract. That is very, very granular. And the fourth feature is it follows one single on-the-run security. Unlike the classic treasury futures, which have a basket of securities, remember the range I told you that they have a range of eligible securities to deliver. Over here, no, they only follow a single on-the-run security for the particular tenor. And the last feature, which is a very important feature, is the DVO1 for CMEU futures is fixed at $10 per contract. So unlike the classic treasury futures where the DVO1 will keep changing depending on your maturity and the number of contract. So a constant DVO1 removes the convexity and non-linear relationship between price and yield. So it's very, very clean, which you will see later in my example. So this is the contract specification for the CME Group yield futures. You can look at this from the CME website. But important point is the minimum price fluctuation of $1 and $10 DVO1. And every month, uh, there will be monthly contract listed for 2 consecutive months and is cash settled or financially settled. So broker tag US Treasury benchmark rate. So the yield futures contract will track the broker tag US Treasury benchmark. And this benchmark reflect the yield of the on-the-run security. So these benchmark rates are calculated 4 times a day. And they focus on the on-the-run US Treasury bond for the tenor below. So again, this is available at the CME website. the published rate will be reflecting actual transaction during a 15-minute window. This is an important concept for CME Yield Futures, and I've highlighted this again that the DVO1 is constant regardless of tenor. In dark blue is the CME Yield Futures. Regardless whether you do the 2-year, 5-year, 10-year, or 30-year, the DVO1 is $10 per contract. This is not the same for the classic or the micro Treasury futures, where the DVO1 is higher for the longer duration tenor, which is to be expected. So one question you might have now is, if I look at the broker tag on the run Treasury yield, would that be the yield that I see on the yield futures? The answer is probably no. There will be a slight difference between the on the run Treasury yield and the yield futures. And whether the yield futures is higher or lower than the OTR Treasury yield, it depends on the carry. If the carry is positive or is more than zero, you expect the yield futures number to be higher than the underlying on the run yields number. So why is this so? If we look at a 1-month CME term SOFR, or simply the financing cost, it's about 5.3% now. This is about the overnight rate. And the yield for the on the run 10-year, which you see on the broker tag, is 4.5725. So the on the run yield is actually lower than the financing cost. That means if the 10-year yield 4.57 is lower than 5.31. So it is a negative carry. The total carry is less than zero. So in this case, you will expect the futures yield or the yield futures number to be lower than the on the run number. So expectedly is at 4.56. So this is just a relationship to illustrate when the yield futures will be below or above. So in a downward sloping curve like what we have today, the downward sloping term structure, the front end yields are higher than the long end yields. You would expect a negative carry profile. So your yield futures number would be a lower number than the OTR number. So this again is a very quick summary of the 10-year yield futures against the classic Treasury futures. So just to quickly recap, main important difference is traded in yield. That's why the name. The settlement is cash, not physical. Contract size, again, a fixed $10 DVO1 regardless of tenor. Tick size is very, very small. It's 1/10 of 1 basis point at $1 per contract. And yeah, these are the main differences. So what is the current market interest rate outlook? So for the US, we can see that, for over the last since post-COVID, you can see that economic activity has picked up. Manufacturing PMI has rebounded from the low. 50 is the line that economists generally believe if you're above means the economy is in expansion, and if you're below, it's in contraction. So US economy has recovered and is doing pretty decent, pretty well. Even for the employment, with the exception of last month's employment, for many months, the employment have been very robust. It have been above 200,000. In fact, in March, it was at 303,000, which is a very strong number. In terms of the average hourly earning, the April's earning is at 3.9%. It's also higher than the long-term average of 3.07%. The red line is Fed's target of inflation at 2%. So you can see we are some way, still above Fed's target, even from a wage perspective. Very tight labor condition is an understatement in the US. If we look at the sub-4 unemployment rate in the US, we are at the longest streak at 25 months since the 1960s. Jobless claim also showing a picture that of a very, very tight and strong US labor economy. US GDP, with the exception of last GDP, was also very stellar, very, very solid. With good quality consumer spending and fixed investment. Which is why the rhetoric has changed from a potential hard landing to a soft landing, and now potentially to no landing or a Goldilocks situation. So US growth has exceeded 2% for 6 straight quarters until Q1 2024. So a lot of economists have started to revise their calls that they don't think the US is going into a recession. The numbers are too strong. It's unlikely that US is going into a recession anytime soon. This is what we do in-house to monitor the global CPI heat map. If the cell is very red, it means that for that particular country, the inflation is way above the central bank's target. And if it's blue, means it's below the central bank's target. So we can see since Jan 2022, inflation where globally went higher all the way to a peak of 9% in the US in June 2022. But over the last 1.5 years, we have seen a steady global disinflation. But until lately, you can see that the global disinflation trend has kind of slowed down and is proving very sticky at around the 3% level. So it's very important to note that the pace, we are going through a disinflation, but the pace of disinflation has slowed down in recent months, with the exception of a few countries like Switzerland, Italy, and China. So if we drill down into the US CPI, so this is a component of CPI. If we break it down into services and goods, we can see that goods inflation has actually come down and has actually bottomed. What is proving very sticky and high are the US core services inflation. And Fed has a very recently they like to focus on this thing called a super core CPI, which excludes housing. If we exclude housing, the super core CPI rose by 4.8% year on year, and that's the fastest year on year pace since May 2023. So from this, you can understand why the Fed is proving it is proving very difficult for the Fed in the face of such strong uh, economic data, especially on the inflation front, to be talking about rate cut. So this is another look on the US core PCE, which is a Fed's preferred measure. Same picture, the services inflation is dominating the inflation picture, and it will probably remain sticky. So if we look at 2024 across all the central bank, at the start of the year, market was talking about 6 to 7 rate cut in the US. So if you look at the gray bar that was at the start of the year, what economists, what market participant was expecting the year end 2024 to be. But in the face of stronger economic data, that probability has been reduced all the way to now market expecting just between 1 to 2 rate cut by the end of this year. And it's the same picture if you look across Europe, UK, Australia, Canada. It is basically a global central bank repricing of the rate cut probability. So this is a quick example of the Fed dot plot. They produce this every quarter, March, June, September, December. So the next one, the next meeting on June 12th, they will be updating these dots. So on the left side is the December dot plot to the March dot plot, and they became less dovish in the March dot plot. So I expect this coming June one to be also to reflect a less dovish Fed. So if you break into the component, you can see that the Fed actually has raised their own estimate of where Fed fund rate will be in 2025 and 2026. And this is also consistent with their expectation of a higher GDP growth, lower unemployment rate, and higher inflation number. But I expect the June dot plot to show a more hawkish Fed that is in line with economic conditions. So this is the Fed fund rate. If you look back to the 90s, it can be very volatile. It just happened that since the 2008 financial crisis, where the Fed brought interest rate all the way down to zero, we have been living in a zero interest rate environment for very long. Until 2015, they started to raise interest rate until 2020. And then COVID hit and rates were brought down very quickly again to stimulate the economy. Until the inflation happened post-COVID, and they were forced to do the first rate hike in March 2022. And since then, they have brought the rates all the way back up to the current level of 5.25 to 5.5%. So the orange line reflects what the Fed themselves think the, the rates were going to be, and the yellow line is current market expectation. So I expect the orange line to shift higher to become more hawkish in line with market expect. So I think that will happen in the next FOMC where they publish their new dots. So another good tool to know will be the CME Fed Watch tool. So you can see this from the CME website, Google CME Fed Watch, and it will illustrate very quickly what is market pricing. So market now, if you look at it, there's a 85% probability of a 25 basis point cut happening only in September. So current rate is at 5.25 to 5.5. So market is basically saying it's a very small chance of a rate cut in the next June meeting, only about 8% probability, and a 33% of a rate cut in the July meeting. But in the September meeting, market think that there's a greater likelihood of 85.5% chance of them reducing the federal Fed fund rate from 5.25 to 5%. So this is how you interpret this table. It is a very handy table to see how market expectation of the Fed has changed. So now we will move on to 4 case study to better illustrate how CME Yield Futures work. The first one would be a flight to quality example. Remember at the start of the webinar, I mentioned that US Treasuries are generally considered to be safe haven quality, which means that in times of crisis like the Ukraine-Russia war, the Japan-Fukushima incident, when markets are fearful, the first thing they'll do, they'll rush to buy US Treasuries and gold as safe haven hedges. So this flight to quality buying typically result in a higher US Treasury bond prices and lower yields. So this is the inverse relationship that we mentioned. So if you want to use the US yield futures to express this, what do you do? So a hypothetical example is on 19 April this year. Trader believe that the Iran and Israel geopolitical tension will continue to worsen. So to express his view, he sold 100 contract of the 10-year yield futures because if he believes the tension to worsen, he expect people to be buying treasuries and the yields to be lower. So in the CME yield futures, there's no inverse relationship. If you believe the yield to go lower, you will sell the yield futures. So that is what he did. And hours later, Israel apparently struck Iran with airstrike, and a risk-off event happened where treasuries, gold and oil soared in prices, and the yield futures yields actually sunk. So the trader managed to buy back the 10-year yield futures at 4.512%. So what is the P&L on this trade? Remember, the dollar value of a CME yield futures, regardless of tenor, is $10. So we next need to calculate how many basis points he made on this trade. So the original yield he went in is at 4.624% to the third decimal place. The price that he managed to square his futures is at 4.512%. So you take the difference, you multiply by 100, that is 11.2 basis point. So the profit on this trade is very simple. You take the number of contract times the number of basis point, multiply by the DVO1, which is always $10, regardless of tenor. So the profit on this trade is 11,200. So look at this. This is an actual yield chart taken from Bloomberg. He sold 100 contract at 4.624, and then the airstrike happened. The yields came crashing down. He bought back the 100 contract at 4.512%. So now we move on to case study 2. So earlier was an example of yields going lower, so you sold the 10-year yield futures. So the case study 2 will be an example on the hawkish repricing of the Fed. So at the start of the webinar, I also mentioned that the Fed has a dual mandate. One of the mandate is to maintain price stability. So this generally means that if the inflation prints are sticky, or the CPI, and it's above the Fed's target of 2%, market will expect the Fed to become more hawkish. When you become more hawkish, it either mean you have a less possibility of rate cut, or you might even be forced to increase your rates. So this hawkish repricing will result in a lower US Treasury bond prices and higher yields. This is the inverse relationship again. So on a hypothetical example here is on the 10th of April, ahead of the March US CPI data, the trader believed that the actual inflation data will be higher than what market expect. So to express this view, he went on to buy 85 contract of the 2-year yield futures at 4.755. So he expect a higher inflation print, means he expect higher yield. So there's no inverse relationship in the CME yield futures. You think higher yields, you will go and buy the futures. So the actual CPI came in at 3.5% year on year, and this was higher than what market initially expected at 3.4. As a result, the CME yield futures rose, Treasury bond prices fell, and the trader sold back the 2-year yield futures at 4.933%. So again, it's always quoted to the third decimal point. So again, DVO1 very simple, regardless of tenor, even though this is 2-year, it is at $10. The number of basis points made on this trade, again to the third decimal, you take the difference between the two, multiplied by 100, is 17.8 basis point. So profit on this trade, again, simple, number of contract multiplied by the basis point times DVO1. So in this case, it's $15,130 profit for this case study too. So this is the U chart of the 2-year. He bought the 10-year, he bought 85 contract at 4.755. CPI was higher than what market expected. And he took profit here by selling at 4.933%. The last two example would be a market, we call it the DVO1 neutral yield curve trade. So what are yield curve trade? It is ideal for investors who do not want to take outright or directional risk. In the first two case study, both the case study and examples are outright and they have directional risk, so they are more risky if you are wrong. So generally, curve strategy are structured to be DVO1 neutral. That means you will long one leg and you will short the other, such that your DVO1 of the two leg cancel each other out. So yield curve strategy, there are two kinds. They are either steepener or flattener. They respond only to change in the shape of the yield curve. So in the case of a parallel shift of the yield curve, i.e. the short end and the long end yields move in the same magnitude, meaning it moved this way, parallel, and the shape of the curve did not change, there will be no profit and loss. Because generally you are playing for a change in the shape of the curve when you do a steepener or a flattener. So what are yield curve steepener? A steepening yield curve indicate that the investor expect the long end yield to rise faster or to fall slower than the short end yield. So you will involve buying shorter term treasury like the 2-year, and you sell the longer term like the 30 or the 10-year. Okay, and in the case of the CME yield futures, because we are not talking about inverse relationship, you basically want the 2-year to go lower, so you sell the 2-year futures and you buy the 30-year yield futures. So you want the curve to basically steepen out this way. And for yield curve flattener, it is the reverse. You want the long end yields to rise slower or to fall faster than the short end yields. So again, in the traditional treasuries, it will involve you selling the shorter term bond and buying the longer term bond like the 10-year or the 30-year. Or in the case of the CME yield futures, because there's no inverse relationship, because you want a flattener, you will either buy the short end futures and you sell the 30-year yield futures. So you want the curve to flatten out this way. So this is the concept of yield curve trading. There are 4 different kinds of yield curve regime. So within the flattening, you have what we call the bull flattening, where the long end yield basically move down faster than the front end yield. This typically happen in flight to quality event where people go, market participant will flock and rush to buy the longer end treasury bond, resulting in the curve bull flattening. The other example of flattening is the bear flattening example. So this will involve the front end yields moving faster than the long end yields. Then in the case of steepening, there's also the bull and the bear steepening. So bull steepening would mean the front end yields moving down faster than the long end yields can move down. So this is typically an example where inflation or something that affects the Fed decision result in market betting that the front end yields is going to drop a lot faster than the long end yields. So the curve will bull steepen in those examples. And a bear steepening example where the long end yields move higher much faster than the front end yields. So there are 4 different kind of regime. Don't worry about the naming of it. It is not that important. More important is the view on whether you think the curve will actually steepen or flatten. So I have 2 case study. The first case study would be one of a yield curve steepener. So earlier in the webinar, we talked about the US debt is now at 34 trillion. Debt to GDP is almost 100%. It is a very unsustainable number. The IMF estimate the fiscal deficit of the US to be 7.1% in 2025. And most economies think that this won't be sustainable in the long run. So it is very natural to expect a higher term premium, meaning that you want, as a bond investor, you want to be compensated for the additional risk that you are taking in terms of potential default risk or credit risk. So the long end yields are expected to rise faster and higher. So to express this view of a steepening yield curve, the trader will sell 100 contract of the 2-year yield future and he buys 100 contract of the 30-year yield future. So essentially, he's hoping that the curve will go down this way for the curve to steepen. So for the 2-year yield futures, this is the initial yield and the final yield. You can see that the slope initially is negative 0.216%. So as mentioned earlier, we are in a downward sloping yield curve scenario now. So the slope or the curve now is negative. So the hypothetical example, the yield curve did steepen out. The final yield of the 2-year and 10-year is as such. The curve actually steepened from a negative 0.216% to positive 0.113%. You can see that the respective yield change are here. The 2-year went up by 7.3, but the 30-year went up a lot more. So the curve actually steepened out by 32.9 basis points. So because you sold the 2-year yield futures, when the interest rate actually go higher, you actually lost money on the 2-year leg. However, you actually make more money on the 30-year part. So as a strategy, because it's market neutral, it's DV01 neutral, you actually still make money because the curve changed positively in your favor. So to calculate the trade, the P&L for this trade, again, very simple, nothing has changed. The DV01 is still $10 regardless of tenor. You just calculate the total change in your yield curve shape, which is 32.9 basis point, and you times the number of contract. So this is the P&L of 32,900 on the steepener trade. Alternatively, you can calculate the P&L on each individual leg. Then you take the summation. It will work out to be the same. So this is a quick Bloomberg chart of the US 2-year and 30-year bond, the spread difference. You can see that it's always a positive difference between the two until 2022 when they started to hike rates. Then the curve became inverted. Although in the recent month, there's a steepening pressure on the yield curve because of the earlier mentioned worries about the US fiscal deficit. To the last case study, we talk about a steepener. Now we'll talk about example of a yield curve flattener. So yield curve typically bear flatten on stronger economic data because you expect the Fed to hike the front end yields faster than the long end yields, and it typically bull flattens on result event like war or a stock market crash. So the trader believed that the incoming US employment and inflation data will be stronger than expected. So this will be a case of a bear flattener where the front end yields will become higher. So to express this view, the trader proceeded to buy 100 contract of 2-year yield futures and he sold 100 contract of the 10-year yield futures. So the workings are the same. You can see that the curve actually flattened from the current 0.216% to 0.342%. So did he make money on this trade? He did, because the curve became flatter. So although he lost money on the 10-year part of the trade, he made more money on the 2-year. So as a strategy on the whole, he still made $12,600. So again, the difference between the two is 12.6 and the curve flattened in his favor. So you can also calculate by multiplying the DV1 and the number of contract and you will arrive at the same result. So again, this is the curve of the 2-year and the 10-year bond spread. Same picture, flattened after the Fed hike rates, and now there's also a steepening bias. So if you want to have a tool to help you monitor the difference in the treasury yield, again, CME has a very useful tool called the Curve Watch. Google CME Curve Watch, and you will go to the website where you can monitor the difference, the respective treasury yield futures, and also the difference in the yield curve, and you can actually do your analysis there. Okay, with this, I've come to the end of my presentation today. Hope all of you have a fruitful webinar, and I'll be happy to take any questions now. Thank you.
Okay, thank you, Lawrence, for the insightful sharing. So we will now move on to the Q&A session. So the audience can drop any questions and we will answer them. You can drop them in the question box above. So, oh, Mr. Lawrence, we have one question. What books
Yes.
can you recommend to us to learn more about treasury bonds and so on? Any books that
What?
you can
Sorry.
recommend? What books can you recommend to us to learn more about treasury bonds and so on?
Treasury bond. That's actually a good question. I mean, I learned myself. I learned the basics from the CME textbook. Sorry, I mean the CFA textbooks. But let, you got me there because I actually learned a lot on the job last time. But maybe let me. I know of a good book, but maybe I can post it to Ivy and you can share with. Is there a way for you to share with them after the webinar?
Um, yeah, I think so. I think we can send an email to them. So send the
Okay.
email to all the attendees afterwards.
Okay, sure. Then maybe you let me go back. I remember a book, but just that offhand I can't remember.
Yeah, sure, sure. So are there any other questions? So if there are no further questions, we will move on to the next session, whereby if you answer the question correctly and the fastest in the comment box, the question box above, you get a chance to win the Touch and Go Reload pin worth 20 ringgit. So the first question is, what is the DV01 of 10-year CME futures? Can any of the audience guess the answer? Any audience can guess? What is the DV01 of 10 years CME yield futures? You can just type your answer in the chat. Oh, we have a winner already. His name is A Tan. Yes, the correct answer is $10. So congratulations to A Tan. Let me just take your email first. One short moment. So congratulations once again to Mr. A Tang. You have won a Touch and Go Reload pin worth 20 ringgit. So for the next question is, if I believe interest rates are going to be going higher, should I buy or sell you futures? So anyone can guess the answer. Oh, we also have another winner from Mr. Ashok. Yes, the correct answer is buy. So congratulations to Ashok as well for winning the Touch and Go Reload pin worth 20 ringgit. So that will be the end of our session for today. I just want
Ivy,
to thank you. Oh, sorry. Yes,
I
Mr.
managed to
Lawrence.
find the book. Can you let me share my screen?
Yeah, yeah, sure. I'll make you
Yeah,
the
sorry.
presenter.
Yeah, so this will be the book that generally when we enter the market last time, all the seniors will ask us to read on this book. So it gives a very good fundamental understanding of fixed income. So you can have a but it's some of the topics can be a bit dry and all, but you can have the quite a good write up on the treasury section inside there. Okay, so I hand over back to you. Yeah, Ivy.
Okay, thank you. Thank you, Mr. Lawrence. So thank you again to you for the informative sharing. So let me share my slide back again. One moment now. Okay, so if you're interested in opening an account with us, you may take a screenshot or scan the QR code here. And for those who are keen to connect with us, you can find us on this platform. Just search Philip Capital Sendirian Berhad on our Facebook, YouTube, Telegram, and Instagram. We post a lot of updates there regarding our events, promotion, market news, and updates. So be sure to follow us so you don't miss out on any of our updates. And we also upload our recorded videos like this session today on our YouTube channel as well. So make sure to check them out. And lastly, this is our branch contact for you to reach out depending on where your location is. So you can visit our branch or contact the branch nearest to you. You can take a screenshot of this as well if you want to. And if you have any inquiries, feel free to drop us a message anytime. So with that, I think we have come to an end to our webinar. We really appreciate everyone for your time and thank you again to Mr. Lawrence for your sharing once again. and we hope to see you all again in our future events. So thank you everyone and have a good night.
Thank you.
Thank you. Bye bye.